Welcome to the Schneider Wealth Management quarter end, and in this case, year end market commentary and review. We're going to get into it. 2023 ended up being a great year, so we're going to get that out there right now. Very good year in capital markets. As we like to say, it's not how you start, it's how you finish, and that will be a through line in a story that Sean and I are going to talk about, throughout this conversation. But I wanted to start out kind of with this video in a similar way that I started out the letter, which is to say, I really embraced it and started to make it kind of my tradition to go in and work the last day of the year, thinking that it would provide some amount of good juju or some good momentum, if you will, for the next year. Let's just say that the correlation is tenuous at best, but it's become my ritual and my tradition. And the past 2 years, I've roped in my daughters, Caroline and Claire. It was wonderful to spend some time with them. And really my tradition is often, is the foundation is kind of based in taking inventory of the year. While the markets finished on a significant rally, it almost made you forget that we had 3 bank failures. Right. Most prominent Silicon Valley Bank. We had a war break out in the Middle East in October when the terrorist group Hamas attacked Israel. And we're entering in year 3 or year 4 of a land war in Europe. International markets were up double digits, right? Both emerging and developed. I was like, the markets felt a lot like that last day of work with Caroline and Claire. I remembered a lot of it, but man, it was over really quick. And I know a lot of things happened. So, with that as a backdrop, let's get into it. The 2 themes that I talked about were what drove capital markets were artificial intelligence and interest rates. If you could claim the mantle of having the most direct exposure to artificial intelligence, the Magnificent 7 stocks, those 7 stocks disproportionately, they were in the haves category. And then there were the have-nots. And if the haves could claim the mantle of having the artificial intelligence, the most direct exposure, the have-nots, well, they didn't have that. But what they did have in spades was exposure to interest rates. Right. The market assessed that they did not have the right kind of market dynamics or exposure, right? That their exposure to sustained levels of interest rates, sustained higher level of interest rates, that was going to be problematic for them. And they traded like that. And for 10 months and 14-ish days, that was the narrative. It was haves and have-nots. Yep. It was a 3 asset class positive trade for most of the year. And realistically, it was like 7 stocks moving the market. Like at one point, the equal weight S&P 500 had a negative return, and the S&P 500 was up like 11%, in part because of these 7 stocks. So I think that's a nice line of demarcation to kind of talk about, the turning point, right? The turning point of markets, being that release of the Federal Reserve notes in November. Let's talk about what moved the markets post that release.
Yeah. So basically, what the Federal Reserve and Chairman Jerome Powell came out and said was they went from a rather hawkish stance throughout all the year, and we transitioned to, well, now we can see 3 rate cuts in 2024. I really like the way you put it in the quarterly letter. As you said, the Magnificent 7 and surrounding stocks were attached to like a SpaceX rocket, and U.S. small caps and other asset classes that were dragged down by the interest rate drag, if you want to call it that, were still in the launch pad. And so what we saw change in Q4, specifically the last 45 days, was U.S. large caps continued to still do well, but what we saw was U.S. small caps specifically and some other asset classes started to play catch up. And those last 45 days, I think, the U.S. small caps were up 18%, while U.S. large caps were up 8%. And so what we kind of been talking about all year, staying invested, we can't just follow 7 individual stocks and that's it. I think the last 45 days, month and a half really kind of taught us that staying invested is really important in this case.
Yeah, and it really seemed like the have-nots became the haves, right? And it was kind of very much based on they had exposure to interest rates, and then all of a sudden that flipped from being a bad thing to a good thing. Talk about maybe to the people watching this, kind of why small cap and mid cap stocks maybe have more sensitivity to interest rates than, say, the Magnificent Seven.
Yeah, sure. So the U.S. small cap, smaller companies, mid caps, compared to their large cap counterparts, they don't have as much exposure to capital markets in the sense of like equity financing. So they have a lot more debt on their balance sheet, and that debt on their balance sheet is actually floating rate. So as interest rates rise, their interest rate expense rises, obviously affecting the income statement, the balance sheet, affecting the company. So it would make sense for them to possibly perform in a less spectacular way compared to large caps. But as we get over that hill of the interest rate hikes, we get into Fed rate cuts, and we start to expect their cost of capital to come down because of their floating rate debt, it would really make sense now for U.S. small caps to start to play catch up, at least in performance wise.
Yeah, and I think that we certainly saw that at the last, right? And I think as we look at kind of the table that the S&P 600, so small caps, so keeping it kind of apples to apples using the S&P 600 to compare to the S&P 500, you had 18.8%, and and the S&P had 8.4% from November 14th through December 31st, and I think that that delta is something that we typically hadn't seen, right? It just had been, large caps all day, every day. Mm-hmm. And if you squeaked out a positive return in the other asset classes and you held a diversified portfolio, it was kind of like this moral victory. Right. And we did really see them start to play catch up. And I think that if rates stay where they are, or continue to trend a little bit lower, if you get that, the inflation readings continue to come down, our expectation would be is that you do start to see, small cap and mid caps kind of continue on that outperformance. In part because from a valuation standpoint, there's still a disconnect, right? Mm-hmm. I think the S&P 500 is trading at around 19 times forward earnings, and that means that for every dollar of earnings that the S&P 500 generates, you're roughly paying $19 for that $1 of earnings. Right. And then I think small and mid cap stocks, kind of the S&P 400, which is mid cap, and the S&P 600, which is small cap, they're roughly trading around 14 times. So it's not to say that we're making a blanket statement about kind of the valuation levels. I mean, I think that my view of the Magnificent Seven is that they are priced perfectly, like.
And not the sense that they have to perform perfectly.
And they have to hit like ever increasing earnings estimates, ever increasing growth expectations. Right. Like the bar continues to get raised higher and higher. And to their credit, they have so far been able to meet them. Although I think at a certain point, the law of large numbers potentially comes into play. And we talk about this in the letter. If you were to add up the market capitalization of the Magnificent Seven, and to review, that is Tesla, NVIDIA, Microsoft, Apple, Amazon, Google, and Meta. Yep. So Meta is Facebook. Those 7 stocks, a little bit over $12 trillion as of yesterday-ish, kind of give or take. The market cap of those 7 stocks is bigger than the market capitalization of the equity markets in the United Kingdom, so Great Britain, England, Canada, and Japan. Right. So those are 3 of the G7, or the biggest economies in the world, and the equity market capitalization of 7 U.S. stocks is bigger than all of them combined.
It's incredible. It's incredible.
Microsoft has a bigger market cap, 4 times the market cap of the Russell 2000, the small cap index. If you believe in the adage of kind of buy low, sell high, or at least in the case of, I think what we're telling clients is maintain your large cap exposure. Yeah. But the next incremental dollar of capital, we want to go
U.S. small caps, mid caps, maybe international developed.
Maybe a little bit of value. I mean, I think value strategies just in general have lagged. So kind of transitioning, and the one thing in the letter that we didn't want to do, because it was you had these giant movements in stocks, and it was the last 45 days were a blur. In addition to having kind of Thanksgiving and Christmas, and then the week after Christmas. It's hard to really explain if you weren't looking at it every day, just how big the move was in stock markets. And I think we've done a good job kind of covering that. The move was just as insane in bond markets.
Oh yeah, for sure.
And I think to review, I mean, bonds are like a seesaw. So as prices go up, yields go down. And up until 2022, yields were going down and prices were going up. And that's, broadly speaking, what you had. Then 2022 happened. And you had the inverse, which was yields were going up and prices were going down. They still kept coming under pressure in 2023. The Fed continued to raise rates. They raised rates. They raised rates. And then in a similar vein to what happened with small cap and mid cap stocks, longer maturity municipal bonds were up like 8% in a quarter. Mm-hmm. Treasuries and agencies were almost up 7%. They went from being negative in the third quarter, like they had a negative total return. From a volatility standpoint, you expect, right? I mean, we expect a certain amount of volatility in stocks.
Yeah.
The volatility in bonds was, even talking about it now and looking at the numbers, it's surprising.
Yeah, and I think if you look at the performance we got from bonds, you probably expect that over 12, 18 months in regards to having an 8% return in bonds.
Yes.
So, like you said, the movement, I think at one point, the U.S., the 10-year Treasury capped out around 5%, mm-hmm. and now we're sitting around 4%. That's 100 basis points right there that we've seen in a matter of a month, 45 days.
What we want to leave you with kind of going into 2024 is that artificial intelligence and interest rates really drove capital markets. I think for Schneider Down's portfolios, for our client portfolios, patience and resilience. Patience to really stick with a diversified asset allocation. And I think the resilience to hold a diversified portfolio, to hold intermediate term bonds, knowing that the short term, the first 9 months of the year might have been difficult,
right? But
that interest rates were likely peaking and were going to roll over, and you wanted to have that exposure because you never know. A big significant chunk of the portfolio was flat to modestly negative to being positive, mm-hmm. and that had a really big impact on returns. So I think patience and resilience, and I think those two themes are going to take us into 2024.
Right. Yeah. I think it could have been extremely tempting, especially in the first 9 months of the year, just to roll over into the top 7 stocks. That's what's working, and that's what's going to continue to work. At least that's what you might have thought. But I got to give a lot of credit to holding a diversified portfolio, and because in the long run, we like to think, a diversified portfolio that gives you exposure to both stocks, bonds, international, domestic is going to really drive performance over the long term moving forward.
I certainly think 2024. There's a long laundry list of things that are going on. We have the aforementioned war in the Middle East. We've got a land war in Europe. We've got this idea of interest rates and inflation. Are we going to get interest rate cuts versus a pause? Or we've got a very contentious election cycle here domestically. We've got a couple other elections
as well. A
couple other elections coming up internationally, and we spent all this time. We haven't talked about China, which is going through its own set of issues. It goes to show you that the characteristics that we talked about, resilience, patience, and really I think it speaks to the need to have an open dialogue and a partnership. But just really grateful, to have your trust and support. And as I think back at 2023, I couldn't have thought of a better way to end 2023 than to spend it with my 2 daughters in a wholly and unexpectedly great year for capital markets. Really happy to kick it off with a treasured colleague in Sean, and really look forward to talking to you guys here in the foreseeable future.